if there was a monster demand that came in right behind you, you're going to get 5 to 8 or more.
Yeah.
So the price target is dynamic. It's going to tell you, the market will tell you, oh, they're buying like mad down here.
Yeah.
It's going to go further, but they're not buying so much.
Mm-hmm.
It's not going to go
So it
far.
might be a modest 3 to 5 point swing.
Mm-hmm.
You can take a chunk of money and just walk away, and you've done for the day.
Absolutely. Yeah.
And this raises another interesting point, because since I've been using your software for quite some years now,
Mm-hmm.
I mean, the first time that I got hold of it, this is amazing. I can't tell you, how many days we had these days where you could pick off 6 or 8 ticks like a dozen times in a day, and it was just bang, bang, bang. But it's exhausting, okay? And of course there are periods when volatility is lower and it doesn't give you that much, and you may only move 4 or 5 ticks and you end up scratching it and running up a lot of brokerage fees and stuff like that. And I think, over the years I've sort of worked with people who've tried to understand how to use this type of software. And one of the criticisms that I had is that people have said, well, there's just so much information.
It's a lot.
And I can't react to it all. But what we're saying here is, don't. It's actually say, focus on 1 or 2 sort of key price levels, and until price gets into those zones, forget about it, just stand aside. Just try and pick off those choice areas where the change of supply and demand is monitored by some of the a tiny bit here and there. Let's just focus on finding the choice places where we can pick off what often is going to be a substantial chunk of money, and let everybody else mess around trying to scalp for 4 ticks a time.
You know what's interesting about that? I talk to a lot of traders. I try to talk to traders. I talk to a lot of our customers. And it seems to me that people have it in their head. They're comfortable swing trading, 3-day swings. They're a dentist and they've got practice and they want to see something like that. Or they're day traders. Their guys are busy and they're like in and they like a 3 to 8 point couple trades in the day. Or they're scalpers. They're in front and they like the action. And often, if you take a scalper and you show them a swing trading methodology or an intraday kind of like 5-8 point swing, a lot of it is not, again, the mechanics, it's the psychology. They're not either comfortable holding something longer or they like more action. So for that person, you'd also have to address that.
Yeah.
You can't just say, well, you're a scalper, here's a great swing trader, because I find like they need to want to swing trade.
Mm-hmm. Yeah, you're right. And actually, one of the things that I always say to people is you've actually got to find the style of trading that suits you personally.
That's right.
Because, trading's a hard business, and we want to have as many advantages on our side as we possibly can all of the time. And one of the advantages is doing something you're comfortable with.
Yeah.
And if you're not comfortable with holding on for 5-6 points, well, don't do it. Focus on grabbing 6 to 8 ticks or whatever the appropriate thing for you is. If you're comfortable with playing for the 1 or 2 decent swings that you can pick off in the morning of the pit session, then great. All you've got to do is just wait for everything to come into alignment, wait for those choice times, put the position on, sit back and let the market do what it's going to do.
That's like some of my trading as well, by the way. I've gone from 7 to 9 tick trader to a 3 to 5 or 8 or much further point trade, and sometimes taking with the big volatility that we're having right now, you can go up to 20 points. But that's right now, it's a great time in the markets. We haven't had that over the summer, but now we have that. But the one thing that I learned that had me evolve from taking 7 ticks or 8 ticks to taking 20 or 25 ticks is just that. Just saying that I know that it's safe to go in the water, and I know if I catch that wave correctly that the exhaustion is there, and then the price is oversold there, and then this massive demand comes in behind me, it's a chip shot. And time again, I take my 2 points off because that's my trading rule, my 8 ticks, and the market would go right up.
Yeah.
And I trade with a bunch of guys, and they tend to be longer term traders than I do, and they're all like, schmuck, you have these perfect entries.
Yeah.
Why don't you change your trading rules?
You just wasted. Okay then, Carl. So just to summarise then, if I understand this right, this is your basically your choice tip, and I think it's a great one.
I think so, yeah.
What you're doing is putting together 3 things, and you're starting off by saying, let's use some clearly identified support and resistance levels,
Mhm.
and focus on those for our zones where we're looking for things to do. In between, let's not worry too much about what the market does. Let's not try and understand every tick, every move, and get ourselves lost in, I've got so much order flow information. Let's just focus on critical areas, number one. Then let's use some of the clever order flow algorithms that you've produced to help us identify whether we've got this sort of exhaustion selling or exhaustion buying into these areas. And finally, then you're saying, then let's wait until the market actually responds by moving up 5-6 ticks and actually proving that the momentum is going to start coming in on the other side. So that we're not trying to catch falling daggers necessarily by trying to catch the very low tick. We're actually waiting to see whether or not there's evidence that something that we're anticipating is going to happen really is starting to happen. If I understand you correctly, those are those three things. Support and resistance areas, monitor the order flow, and if that then does what we expect it to do, and then the market then starts to respond to it, another three, then we pile in, and that's when we start to look for our swing in the opposite direction. Is that right?
I couldn't have said it better.
Great, great. Well, with that then, I'm going to say thank you very much for those words of wisdom, Carl, because that in itself, one of the things about interviewing, some of these top traders that I'm doing on this little tour around the States is that, anyone that's listening to this could take any one of these nuggets of information and they could turn that into a business, just any one of them. And, what you've presented here today, the concept is simple, it's straightforward. The tools, you spent years, decades even, perfecting to make it so easier for us to sort of execute these things and put them into practice. All anyone's got to do is actually decide, does this sound like the type of trading that suits me and my personal style? And in which case, there's nothing to stop me getting on with it and starting it next week.
Exactly.
It's simple as that. Yeah.
Very straightforward.
Thank you very much, my friend.
Thank you, Simon.
Thanks for sharing that with everybody.
Listening.
See you again.
Okay.
Bye.
Craving better trades? Use better data. Powered by Skeeto. Whether you're a fib trader or you use Elliott Wave, whether you like to buy support or you prefer to enter an existing trend, the Achilles heel of technical analysis is the false signal. Here's the reality of the trading world as dealt with by Joe the trader. Let's look at Joe's trading plan for today. I'm buying the first retracement back to the overnight low, said Joe. Here's the overnight low, the open, and the first retracement back to the overnight low. Should Joe buy here? Or should Joe stand down and wait for the next setup? If they are buying, then it is safer for Joe to be buying. The order flow bars that you are witnessing in this broadcast stream will tell you the level of demand-driven order flow, supply-driven order flow reversal from supply to demand, order flow reversal from demand to supply, exhaustion of order flow in the order book. If you think that is cool, well, there's a whole lot more. Head over to www.skeeto.com. Coming up next, Elliott Wave meets order flow. Elliott Wave is great, but sometimes the 4 wave becomes an A correction, and your trade becomes kaput. Here's an idealized Elliott Wave. Here's a noisy Elliott Wave, one that you are more likely to encounter. Here's an approach to dealing with the noise. Ideally, we would like to buy at 2 or 4. But how do we know in real time if 2 or 4 will hold? The short answer is that we look to order flow to tell us. Let's roll up our sleeves and dig down into the order flow data and see if there's anything obvious and logical that we can use to our advantage. Order flow insight. Corrective Elliott waves are often accompanied by exhaustion in the order book. This warrants repeating. Corrective Elliott waves are often accompanied by exhaustion in the order book. Let's revisit the noisy Elliott wave. Between 1 and 2 is an ABC corrective wave. C is our area of focus. C is where we look into order flow for selling exhaustion or a reversal from selling to buying. If there is selling exhaustion in the order book at C, then there is a reference in order flow that only buyers remain. These buyers pressure the demand side of the supply and demand curve. This demand pressure will push price upward and allowing the resumption of the uptrend to ensue. How to spot exhaustion or reversals in the order book at C. We use order flow bars to help visualize order flow. Order flow bars can tell you in real time whether there is a demand to supply shift, a supply to demand shift, even exhaustion in the order book using this color coding. Order flow reversal from supply to demand, order flow reversal from demand to supply, exhaustion of order flow in the order book. This is an uptrend. This is a white exhaustion bar at C. Now that the sellers are gone, the buying demand pushes price upward.
Okay, so we're going to go through a head and shoulders pattern, actually an inverted head and shoulders pattern. So the inverted head and shoulders pattern has a left shoulder, which is really just a pivot low. And the trick is that the head is a lower low than the pivot low, which is down here. And then you have a right shoulder, which is a higher low, higher pivot low than the head. There are 3 phases here. So we have the left shoulder, with the head, and here is the right shoulder. Then we look for 3 distinct things in each phase. The first phase being the left shoulder. Here, we're going to look for, when we see this occur, a pivot low, we're going to look for a lower low. The head here is the lower low, and at the head, we want to see a couple things. We want to see exhaustion here in the selling, right around here. We call it conclusionary, C-O-N-C, conclusionary. When we have exhaustion state down here, we want to see in here is new fuel, NF. New fuel is really buying that comes in that's going to push the market up after the exhaustive selling came in and created a vacuum. We're going to look over here for the right shoulder, which is the next pivot low. It's the higher low after the head. And right here,
through this stage here, we want to see supportive order flow, what we call lift, which is really manifested by a bunch of green activity. If you have that, right here is the ideal entry place. If you have a range bar, you look for a range bar that closes up, and you want to enter immediately after the range bar closes up here. And this would be a three-wave. This move up here would be a three-wave in Elliott. And you want to catch here is to take a long trade up here. That's the essence of it.
Okay, Carl, welcome.
Simon.
Great to see you at
Thanks
last.
for having me. Nice meeting you finally.
Pleasure. And thank you for addressing our guests today and giving them some of your insights.
My
And I know
pleasure.
you have got so much you could share, but the reality is that we really want to just take sort of about 10 minutes and say, from all of the lessons that you've learned over this period of time, I know you've distilled an awful lot of learning down into a number of actually reasonably straightforward concepts. And if you could just pick one of those to share with these guys, it would help them enormously. So,
Okay.
over to you, my friend.
Oh, well, thank you, Simon. So, I was thinking about that. You had teed up that question previously to me. And I think the one thing that I have learned is that the market does things for a reason. And then often we see in the news, oh, there's interest rate changes or earnings or the price of crude oil. But that's not really what affects price in the short term. In the very short term, it's all about supply and demand.
Yeah.
It's not about the macroeconomic events. It's about, is there a preponderance of buying and demand, or is there a preponderance of selling and supply? If there's more supply than demand, price will go down. And if there's more demand than supply, then price will go up. And what we do, and we spend our time and our obsession, is really looking at order flow. Because in the electronic markets, changes in price are always a function of changes in order flow. So if you can monitor order flow and you can see accelerated selling or decelerated selling or accelerated buying, you can infer where you're going to have reversal points, acceleration in price, air pockets or vacuums, or what some people call exhaustion, that need to get filled and then price will respond. So one of the things that I've learned that I always tell people is that it's good to think in terms of always being like that old-fashioned tape reader. What is order flow, or what used to be called the tape, what is order flow telling us about now, and how is that going to affect price in the short term? Because we're short-term traders, so we're always looking at short-term models.
Yeah, absolutely. And one of the things that I've taught people for many years is not to worry about this stuff like interest rate changes, news, price of crude, because at the end of the day, the market can only move based on supply and demand. So anything that goes into decision making that results in market movement has to translate itself via supply and demand, or changes in supply and demand, in order for the market to respond to it. So therefore, all of this other stuff that a lot of people it may form part of their decision making, actually we don't care about that. All we care about is what the market actually experiences, which is supply and demand and nothing else.
Nothing on our time frames.
Oh,
These
exactly.
kind of short-term intraday time frames,
Exactly.
the market can go down, up, down, up, down, up. Interest rates haven't changed. There could be an economic announcement. Oh, housing starts are up. The market can go down, up, down, up, down, up. Each time when it went down, there was more supply. It went up, there was more demand. Housing starts are the same, went down again. 40 minutes after the announcement, housing starts are still the same. There was more supply.
Exactly.
Yeah.
Exactly.
And what we see is actually, we've learned quite a bit about supply and demand. And there's a couple of things in the tape. When we say order flow, or I say order flow, I'm a little older, so I still call it tape. What we see in the tape is certain behavioral patterns that we've kind of come to identify. Like when you look in order flow, you can look at it a couple of different ways, and we have all these different algorithms that look at order flow in different ways. We look at the overall aggregated order flow, let's say for the S&P E-mini forward futures contract. That contract is traded in Chicago. It's not traded in a pit, it's actually traded in a rack of servers at the Globex exchange, which is owned by the CME, and they have these transaction matching engines in the server. They match buyers and sellers. They have an electronic record of that, that's distributed. And what we do is we monitor those Globex servers, and we also monitor a very specific process of how the order flow comes into the order book, gets executed, completes, and then new orders come in. Most people would call that a reversal. And the one thing, like, if I think that traders should think about when they're trading is they should think about, like, well, if price is coming down to known support, what does that look like? Because a lot of people say, oh, after the fact, they said, oh, I saw exhaustion. There was exhaustion selling. And we have a little bit of a different take on that. We're like, well, you don't really have exhaustion selling. You have a state of exhaustion, which is a vacuum. So if the market was to come down and there is no more selling, there's no more supply, the supply has been exhausted. So the selling, the activity is an activity, but exhaustion is actually a state. We've talked before how nature take a scalper and you should have swing trading, that vacuum has methodology. Or more than likely, if you have a vacuum state of exhaustion, a lot of his volume comes in, which you can see from the tape, the order on the server is holding something longer or in an area of a vacuum. So for that person, and that I think is a very easy concept for address that. Oh, I get that, right? Supply and demand. You can't just say, well, you're a scalper, here's a great swing trader, because you should have some conclusion, which creates a state of exhaustion swing trading. New buying comes in.
You're right. And actually, one of the things
Price has got to go up.
say to
That's a good place to trade.
you've actually got to find the style of trade.
If you're trading support, that's right.
Because you
Add in
trading's a
order
hard
flow
business,
on top of
and we
your
want to have as
analysis,
many
you're going to have a better
advantages on our
handle.
side
Because
as
let's
we
say
possibly can.
price
all
is
the
coming
time.
down to support, and you see
And one of
selling.
the advantages is doing something you're comfortable with.
Yeah, then it
And
comes
if you're
through
not
support,
comfortable
and
with
now you
how
see
it's gone
increased
for 5,
selling
6
right here.
points,
In the order flow.
focus on graphs,
support breach, you're gonna go down.
whatever the appropriate.
So to know that
is.
in real
If
time
you're
what's happening right
comfortable
here
buying for the
is probably,
one or two
I think,
decent swings that you can
the
pick up in
best
the morning
seatbelt
of
that a trader
the
can
session,
wear.
then great, all you've got to
And
do is
bring it to their
just
trading
wait
for
for
them.
everything to come into
And
alignment.
you've hit upon something
Wait
there
for those
that
choices
I think is
that are
really
choice
important
time
these
days,
days
put
on
that position on, sit back, let the market do what it
At
can
least
do.
on a short-term basis.
That's
and
like some of my
short-term
training
traders,
involved,
at
right?
least for a lot of
I've
people,
gone from 7 to 9 tick
Reversal
trader
trading is
to a 3
more
to
important
5
today
or
than
8
it
or
was
much
in the
further
old days.
point trade
And
that I'm
a lot of
taking with the
people,
big volatility that we're
in
having
the
right now.
past,
You
they
can
should
go
always
20
trade with the
points,
trend.
but that's right now,
Yeah,
it's a
trend.
great time for
Trend,
markets.
trend.
We haven't
Mhm.
set up the
Mhm.
summer,
And
but now
hence
we have that.
people
But
on small
the
time
one thing that I
And as far as I'm
learned
concerned,
had me evolve
that
from
change that we've
oh,
seen over
taking
recent
7
years,
ticks or 8 ticks to
is as a
taking
result of the fact that we've moved
20
from
or
humans
25
driving
ticks.
most of the volume to the machine.
is just that, right? Just saying that,
So
like,
therefore,
oh,
people
I
have got to get
know
out of
that
their
it's safe to
mind's
go in the
obsession
water,
with,
and I
oh, you
know
only
if
ever
I
want to
catch
trade
that wave
continuation
correctly, that the
patterns,
exhaustion is
because
there,
reversal
and then the
patterns
price is
are
oversold there,
probably
and then this
more
massive
important now
demand
than the small
comes
time
in
frames
behind
than
me.
they were in the past.
It's a chip shop. You put up something really interesting. Time and time again, see, like, take my 2 I've been trading for a long time, so I've watched price behavior change, and the market would go right up, pit driven, and I trade with a bunch of guys, ebb and flow, a lot of traders used to, and they're all like schmuck. And a lot of the perfect entries is gone now. Why change your trading rules?
Would you just wait?
Okay
Okay then, Carl, so just to summarise then, if I understand this right,
And now the
this is
machine's traded, the
your
price
basically
action
your
patterns
choice
that
tip,
people
and
used
I
to
think
trade
it's a
on.
great one.
I think so, yeah.
What you're doing is putting together three
But I
things,
think that some
And
people like,
starting
oh,
off
it's
by
terrible,
saying,
the
let's
machines have
use
taken over, and I say, no, it's
clearly
good.
identified
Because those machines are not trading in the pit. Where you
And
really don't know
focus
what's
on
going
those
on,
for
and
our
orders,
zone.
people screaming your invisibility. Those
In
machines are
between,
trading
let's not worry
in
too much about what the market
and they're
does.
leaving
Let's
their
not try and
footprints
understand
on the
every
tape.
every
Exactly.
move.
And
Get ourselves lost
if you
in-
know
Yeah,
what
so much
their
more
buying and selling
information. Let's
patterns
just
look like
focus on-
at
on-
these
on
known
critical
support and
areas.
resistance
Number
levels,
one.
then you can say,
Then let's use some
You're
of
done
the
selling that.
clever
I wanna do
order flow algorithms.
so I think that the rise of the machines is
Help
actually
us
become
identify
great thing for the
whether
smaller
we've got this.
traders.
Yeah,
It also brings us a degree of consistency into
necessarily there before.
Mhm.
It's just you have to
Finally,
find
then
to
you're saying,
adapt the way
then
you
let's wait
go on.
until
And
the
trading
market actually
systems
responds by moving
machines
up
behave
rather
ticks
than
and
actually
humans.
proving
Yeah.
that the momentum is going to start.
So we have this
coming
concept
on the
actually
other side.
that
So that we're
started
not
to
trying to
document
catch falling
because
down.
it's really formulated in my mind. It's a lot of mind trading and some other guys I
We're
trade
waiting to
with.
see
whether or
We
not
talked earlier about conclusionary selling.
something that we're anticipating is going to happen.
One of the things that we found very interesting is
if I
that
understand you correctly, those are those three things.
most people refer to
Resistance
conclusionary selling
areas,
as exhaustion. And as I said, we don't refer to it as exhaustion. Exhaustion is the end state of conclusionary selling. And what we have found is that there are actually three distinct flavors of conclusionary selling. And when price is coming into no support, one of the things that we do
with
is
that, then, I'm going
we
to say
look
thank you
for
very
one,
much for
two,
that.
or all three of these flavors or behavioral
that in
patterns of
itself,
conclusionary selling.
One of the things
And
about
we use,
interviewing some of these top traders that
it's
are
very
doing
standard
this,
support
on
resistance
this
levels.
little
Like just to
tour
give a great
around
example
is
is
that,
the overnight low.
anyone that's
Right? The overnight low is important. When the market starts trading on the overnight high, the first time price revisits that, we know that that's no support.
something's going to happen.
Something's going to happen.
You know, what
Higher day
you're
low,
presenting
these are
here
very
today,
important easy markers.
the concept
And what's
is
nice
simple,
about them is
straightforward. The
if you're
tools,
trading
you spent
the day session,
years, decades,
you have plenty of time to draw a line from the overnight
so
low
easier for us
across
to
your chart.
execute these things and put them into
If it's
practice.
the overnight high or the Friday high, you have plenty of time to draw it up and know in
Does it sound
advance
like
my game
a
plan.
plan?
Oh, I'm waiting for price to get over there.
That suits me.
And then once price gets in that neighborhood, I'm going to look for either conclusionary selling if it's going to support, or if it's going to go to the overnight high, I'm going to look for conclusionary buying.
Thank you very much, my friend.
Thank you, Simon.
Thanks for
I can
sharing
be
that.
forward
with us.
thinking. I have plenty of
See you
time to
again.
watch and wait and see what happens. I'm not just going to automatically buy and sell. So what we look for is these three types
Craving
of
better
conclusionary
trades?
selling, which I find so interesting.
Use better data.
The first
Powered by Skeeto.
type of conclusionary selling is really the aggregated.
Whether you're a fib trader
we measure
or you
the
use
rate
Elliott
of change of order flow on the global.
whether you like to buy support
So if you have
or
an
you
S&P
prefer to
E-mini
enter an
500
existing
futures
trend,
and you have an overnight low and
the
a
Achilles
horizontal line
heel
going
of technical
across,
analysis
the price
is the
is coming
false
into it.
signal.
We should see coming into that
Here's
low
the reality of the trading world as dealt
a
with by
decrementing or diminishing rate of change of sell orders.
Yep.
That means it's slowing down.
Yep.
Coming into it before, on the way down, we're going to see an increasing rate of change on the way down. But as it gets closer to the low, we should see a decrease in the rate of change of selling.
Yep.
So that's one type of what we would call conclusionary selling. Because theoretically, if you continue to diminish your selling, the rate of change of selling, at some point you'll have zero selling. Then your curve will turn and you'll have an increased rate of buying or demand. So that's one flavor. Another flavor that we've seen and we monitor is very interesting is what we call late traders. So those are people who come in late to the game. And what we do for that is we do a lot of intermarket analysis, particularly on the S&P 500. So whereas our first type of conclusionary selling is the overall aggregated order flow.
Yep.
The second type, this late selling that we see, or late buying coming into the high, what we do is we look across each component of the S&P 500. And this is what's really cool about the S&P futures contract. It's arbitraged and it's tied back to the actual components of the S&P 500. There's 500 stocks you can monitor, Ford and Apple and Amgen or whatever you're watching. And what we do is we monitor those. And when we see the market come down to the low, but we see an accelerated rate of selling, new selling come into the equity side, we say there's people late to the game. Mm-hmm. And you can actually see that on the equities tape. And with charting today, you can line up data from the equities tape, put it on your futures chart, and go, oh my God, look. So if we see price coming into support, we see the overall rate of change on the order flow from the Globex surface slowing down, yet we see late selling on the equity side, that's two of the conclusionary selling. And then the third type of conclusionary selling is more people would call the classic one, and that would be panicked or troubled traders. And then that you see in a couple ways. You see perhaps increased volume at a few very precise tick points.
Yep.
Whereas I think people used to look for volume spikes. Mm-hmm. Remember, like, oh, there's a volume spike? That doesn't work anymore. The volume spike may or may not be conclusionary. You don't really know. So what we look for at specific price points, maybe 2, 3, 4 ticks above the overnight low, we're going to look for an accelerated number of transactions. And what we do is we put all this into like a bell curve. So we look for something to be 1 or 2 standard deviations above the average, and we denote that. Yep. Either the amount of selling is defined by the number of transactions occurring at a particular tick, the overall volume at a particular tick, or more importantly, in terms of exhaustion, is like the up-down tick ratio, how price bounces around. We monitor that in the order book. So if you ever trade on a dome and you see the price ladder, that in there can infer exhaustion.
And of course, don't forget that some of that happens so fast that actually, if you're looking at the order book or the dome you're trading off, you're not going to see an awful lot of that because it's too fast.
It's hard.
Yeah.
It's hard. Or you can get fatigued or you're not there. So, but that's the kind of thing that software is very good at.
Exactly. The software does it for you. So
Yeah,
you
it
don't
doesn't
have
get
to.
tired.
Yeah.
It takes care of that. And you just, oh, the pretty alert came up. I see it. I see conclusionary selling.
Yeah.
And what that means, though, the conclusionary selling is not like, oh, all's clear to buy. What we generally do is we wait for that to hit support. And then what's really neat is, you know, there's the concept of price reversion. Price tends to revert to the mean. By and large, if we see price coming into support with this conclusionary selling, either the late selling, the panic selling, or the overall diminishment of order flow, if we see that happening, what's also going to happen is price is going to extend, generally beyond a bullish
I was going to